Well, despite today's major sell-off, our next guest sees a year-end rally shaping up, says to buy the dip. For more on that, let's bring in Fundstrat's Tom Lee. This is the dip that you buy?
Yes. It's a dip where the VIX has spiked. We've had basically a waterfall collapse. And we know that we're going into this period where 74% of active managers are trailing their benchmark. So I think that the urgency or the urge for markets is really to put capital work to sort of close performance, which means a rally.
Do you think that the declines that we saw in the markets today are really as bad as they seem on paper when you take into consideration the role that ETFs are playing in these markets, and that you're selling, when you sell 3 of the ETFs that you probably own, you're selling the same stocks over and over and over again?
Yeah. I mean, there was a big correlation increase today across markets, and part of it is that there is deleveraging when rates are high and when volatility is spiking, and we know risk parity funds were overweight bonds, so I think this is a lot of position squaring. But once this is behind us, I think people have to think about where opportunities are, especially under inflation, and equities really are the place to be.
So, Tom, I know you do a lot of quantitative work, and that's been fantastic this year. What are your quantitative models saying about this? Let's take the emotion out of it. What do the machines say?
So, quant funds almost universally like growth. And even our quant model by Sam Doctor is overweight growth. So one of the things that is crowded today is people are long duration, either in credit, right, through bonds, or through growth stocks, which are long duration assets. So a shift towards higher rates is a shift towards asset intensity. You want to be long assets, not duration, which means you want to possibly think about owning growth value stocks now.
How are assets? All stocks are assets, right? So I don't know what you're saying by that.
So the adage used to be that it's harder to make a lot of E to offset PE. So meaning in a world of rising inflation, an asset-intensive business like financials can generate tons of earnings leverage because assets are growing, they're deleveraging, plus they can earn margin. If you're an asset-light company, like an R&D-based company, it's tough to actually keep up with inflation because you have labor costs, and the only thing you have is units growing for you. So asset-based businesses are value stocks.
Tom, getting back to buy the dip, so I'll play devil's advocate. The S&P is down 5% from an all-time high, albeit 3 of those percentage points were today. What needs to change in order for it to be from buy the dip to maybe this is the beginning of something larger?
Well, the one metric we watch very carefully is the yield curve, because you can't fight against an inverted yield curve. That tells you confidence of the future has gotten so bad that markets are contractionary. The curve has been steepening, actually, in this sell-off. So I actually find that pretty bullish, that we've had sort of future expectations improving.
So I'll piggyback that. You said risk parity. The last time we had this risk parity event, we were trading down between 11 and 12%. So Guy had said it's down 6%, 3% today, basically. Is it a technical bounce, or is it a numerical percentage that we're coming off of for risk parity? Because risk parity has to be somewhat the same, linear, in its very essence of it. So, and we've seen the market run up. Granted, we haven't run up that much. Is it a percentage basis or a technical?
It's probably a little bit of both, because risk parity is going to want to overweight low vol and underweight high vol. And equities relative vol at 20 is actually, it's a spike, but it's actually relatively low vol. So I think equities sort of get an allocation. But you have to remember the seasonals are really good. I mean, a correction happening, let's say in May or the summer, is scary because we have bad seasonals. Now we have good seasonals at a time when there's performance chasing. So I actually think it's a good opportunity here.
Last question, I want to underscore the message that you're sending to viewers right now, and that is you buy the dip, but you want to buy the value stocks going to year end. That's where the rally is going to be? Or is this going to be a broad-based rally with the same old players playing along, the FANG stocks, the tech stocks, et cetera?
Yeah, so I have two frames. I think into year end, I think people go back to their favorites on their shelf. So all these FANG names that have pulled back look really cheap because they probably wanted to buy them at these levels, or PayPal in the 70s. But next year, I think it's a story of markets are broader. It's really narrow this year, and it's more asset-based, which is pro-inflation trades, and it's probably a shift to value. I mean, that's one of, I think, the more important moments that's happening this year.
Tom, good to see you. Thank you.
Yeah, great to see you guys.
Tom Lee of Fundstrat. Do you buy Tom's market playbook?
Listen, I'm always a half-empty person. So, I mean, I'd love to be optimistic. By definition, I'm not. So I do believe this is the beginning of something. Now, I'm not saying 20%, but anywhere from 12 to 15%, given the double tops we made to Steve's technical point in the S&P, I think there's more pain to come.